Dear investor, Edelweiss Private Wealth Management is pleased to present you the latest issue of Investment Strategy Report for May 2018. Let's take a look at key highlights of April. International Monetary Fund projected India's GDP growth to accelerate to 7.4% in financial year 18 and 7.8% in financial year 19, consolidating its position as the world's fastest-growing major economy. The India Meteorological Department predicted third consecutive year of normal monsoon with rainfall expected to be 97% of long-period average. Index of Industrial Production for February 2018 remained strong at 7.1% year-on-year, posting fourth consecutive 7% plus print led by favorable base effect, robust retail financing supporting strong auto sales, and healthy spurt in commodity and capital-intensive exports. US 10-year Treasury yields breached the psychological level of 3% that caused the US dollar to appreciate against emerging market currencies, including the Indian rupee, as FIIs took flight. International crude oil prices are at their highest level since 2014, briefly touching $75 a barrel on account of geopolitical concerns over likely US curbs on Iran, OPEC and non-OPEC induced supply cuts, and continued strong demand. Nifty posted a sharp recovery this month, moving up by 6.2% after two consecutive months of fall, though we must remain cognizant of the global and local risks that persist in the market. Flattening US bond yield curve, geopolitical events, trade war fears, aggressive earnings growth assumptions, and mixed domestic macros remain the key risks. We expect Nifty top line to grow by 14% year-on-year and bottom line by 15% year-on-year in Q4. Auto, metals, and oil and gas are expected to drive Nifty earnings, while cement and telecom are expected to be the draggers. We maintain our Nifty target price for financial year 19 to 11,500 and continue to remain bullish on consumption, capital goods, building materials, and road construction sector. EPS estimates for Nifty index for financial year 19, financial year 20 and financial year 21 are Indian rupees 594, Indian rupees 703 and Indian rupees 811 respectively. As per blended estimates, index is currently trading at PE of approximately 17.6 times 1 year forward. We recommend investors to deploy 33% of fresh equity allocation, while the remaining can get invested over a 3 to 4 month period in a staggered manner. Clients having high exposure to mid and small cap via direct equities may look at trimming their positions and moving to large caps or managed solutions. The 10-year benchmark GSEC is hovering in the range of 7.15% to 7.80% on a semi-annualized basis. The bond yields have seen quite a bit of volatility in the last few weeks on account of a host of domestic and international factors. The RBI, in its monetary policy, maintains status quo while revising the inflation forecast for financial year 19 downwards to 4.7% compared to 5.0%, fueling a rally in bond markets. The unexpected hawkish tone of the MPC minutes, released post a fortnight though, caused a tumult in the market. The higher indicative borrowing calendar for state development loans and low FPI limit increase in government bonds led to a steady rise in yields. A sharper than anticipated moderation in food inflation to 3%, mainly vegetable prices, pulled CPI inflation to a 5-month low of 4.3%, even though core inflation ticked up to 5.4%. We expect benchmark yields to remain volatile and trade in the range of 7.40% to 7.80% with an upward bias of 30 basis points. Yield movement hereon will depend on inflation trajectory, crude oil price, supply-demand dynamics, and global bond yield movement. The hawkish undertone of the MPC meeting minutes have increased the probability of rate hike going forward in the event of an adverse movement in inflation. We recommend investors to allocate 100% of their fresh fixed income allocation to long-dated buy and hold strategies and active accrual strategies with low to medium duration.